Okay. Joy spoke about the evolution of banking and how banks have had to change and innovate over the years to provide new banking services as well as provide new products over the years and change with the circumstances. Today, we are at such a juncture where banks have to move beyond their traditional physical locations and go increasingly digital. Faraz and I will be talking about Beyond Resilience, Phygital, the next normal for BFSI in a post COVID world. Today, in our talk, we'll be talking about first everything that's been keeping us indoors, COVID, like what's the impact of COVID on banking and financial services. Then look at where the major banks and insurance companies are spending in terms of digital engineering. Then we are going to take a look at where disruption is happening, and then finally the role of Indian GCOEs and how they can contribute to their headquarters. First up, let's look at what the impact of COVID is on banking financial services. So we did a study and analyzed where COVID is impacting banking across the four major verticals: retail banking, commercial and wholesale banking, wealth and asset management, and investment banking. Now, this time, as compared to say 2008, banks are heavily capitalized. Banks this time might come out as the saviors and not like survivors like last time. They have enough and sufficient buffers to ride out the storm. But what's happening is around the world, people are losing jobs and there is increased income uncertainty. So what's going to happen is the overall spending is going to come down, leading to lower payments and credit card related transaction income for retail banks. Commercial and wholesale banks may see an increase in, say, working capital loans and short term lending related instruments. But what's going to happen is commercial banks are actually going to act as the agents for government aid. Major central banks and governments around the world have basically instituted federal stimulus packages, and banks are going to act as the arms and legs for distribution of these, say, small business application loans or paycheck protection program loans. Wealth and asset management companies have had to deal with increased stock market volatility. The equity markets are still extremely volatile. So we expect that wealth management companies are going to see lower assets under management and lower net new inflows. Investment banking companies are going to have to deal with a liquidity crunch, so capital raising might be an issue. M&A advisory, we might see that the number of deals might come down, but securities trading and the increased stock market, if taken advantage of correctly, might actually give investment banks some ray of hope. Now, I did say the banks are heavily capitalized, but what's going to happen is banks are actually setting aside loan loss provisions because they're expecting customers to default in the coming months. Now, these loan defaults are going to take a hit on the banking bottom lines. Also, we have seen, unsurprisingly, banks have made the top 20 of the most used apps on, say, the Google Play Store and the App Store. So increase in digital channels is one of the major impacts of COVID on banking. Now, increase in digital channels is such a major outcome of COVID. Let's look at where banks have actually been spending in terms of digital engineering. Now, Zinnov conducted a study on actually basically where banks are spending in terms of, say, new consumer facing products, not necessarily the infrastructure upgrades that are pending for a long time, but new products, consumer facing, revenue generating products. And what we found is among the Z1000 Zinnov organizations, banks are expected to spend 38 billion US dollars in digital engineering. Now, these spend the $38 billion is expected to grow 18% year on year over the next 5 years. And the major categories of spend is cloud, big data analytics, artificial intelligence, security, and blockchain. Now, big data analytics forms almost a third of the spend, and cloud, even though banks were a little apprehensive about embracing cloud, now banks form almost a third of their spend in cloud investments, either in private, public, and hybrid cloud, multi-cloud architectures, or in just building cloud-native applications. Artificial intelligence, machine learning continues to be a major investment categories, and this is going to increase going forward as well. Most banks are now using artificial intelligence based virtual assistants and natural language processing for, say, claims processing by insurance companies, and algorithmic trading and robo advisories by wealth management companies. Security, like I said, is a major, I would say, cost and spending category, mainly because when the number of digital channels are increasing, what's happening is banks are focusing on cybersecurity, fraud detection, and attack rebuttal software. Blockchain, even though banks spend almost $1 billion on blockchain cumulatively, it is still a very nascent category and restricted to, say, international cross-border payments or in terms of smart contracts. Now let's look at where each of the major banking verticals are spending money on. Retail banks have had to deal with lower and lower net interest margins. Now, with the pressure on margins, banks are trying to increasingly do a digital first philosophy. So, banks are spending on top digital products like KY, Know Your Customer, anti money laundering, compliance reporting, liquidity and risk management products. JP Morgan Chase spends almost $11 billion on total tech spending, with over $1 billion on just digital engineering spends. Insurance companies have had to deal with higher and higher claims processing costs. So what insurance companies are doing is building better patient experience and digital healthcare products to lower their cost to service. Telemedicine products, actuarial assessment platforms, computer vision based claims processing platforms are some of the major categories in which insurance companies are spending money on. Commercial and wholesale banks have had to deal with lower loan growths over the years. So what the commercial banks are spending money on are better SME lending and trade finance products. Commercial banks spend almost $1 billion in AI ML based trade management platforms. ICBC, which is the largest bank in the world, Industrial Commercial Bank of China, actually has disbursed over $1 billion in government infrastructure project based loans to SMEs in China using their blockchain product. Wealth and asset management companies have had to deal with lower and lower assets under management fees. Now, the total assets under management are going down, and especially because of COVID, people are going to get more risk covers. So net new inflows are going to go down for wealth and asset management firms. So they're spending more on robo advisors to cut down on costs, as well as AI-driven personalized wealth management and advisory platforms. Morgan Stanley actually has built their next best action AI wealth management advisory platform out of their India Development Center. Investment banks have had to see lower and lower revenues over the last 10 years, with their revenues declining a consistent 2% year on year. So they're investing on AI ML based trading platforms, as well as investment research and advisory platforms. Now, we saw that this is where the major banks are spending in terms of digital engineering. But as these banks are spending money in building all these products, the landscape around them is changing. What's happening is banks have had to deal with varied regulations around the world, and these regulations put a pressure on their costs. And as they're dealing with high costs of compliance, they also have to deal with legacy system modernization and make sure they come up to embracing the cloud. They also have to look at new business models and operating models like API banking and open banking. Now, when banks are dealing with high costs of compliance and trying to modernize their legacy systems, they also have to see these new entrants like tech companies like Amazon, Google, trying to enter banking. Amazon has Amazon Pay, Amazon Cash, Google has Google Pay, and then you have more than 12,000 fintechs entering the banking domain as well. What's happening is these fintechs and tech companies are simplifying access to banking products, and this is actually making the millennials eschew traditional banking and prefer a new digital based tech companies and fintech based banking products. And like I said, these millennials are actually preferring fintechs and tech companies. So banks are getting disrupted across every major process area in their banking value chain. New fintechs are coming up in, say, the payments and deposits area. Digital only banks like Monzo, Revolut, N26 are actually capturing almost a third of the new bank accounts being opened in UK. Chime is attracting customers in the US. Now, these are digital only challenger banks. Credit cards, you have major API based products like Stripe, and then you have P2P lending based payments like Venmo or Google Pay or Paytm here in India, who are actually disrupting the banks in payment areas. So what's happening is all these companies are actually making sure that traditional banks get left out and millennials go and embrace these new fintechs and tech companies. Now, what should the banks do to actually thwart these new entrants? A new fintech like Cabbage can give out a loan in 7 minutes, whereas a traditional bank gives it out in 2 weeks, and some could take even a month for just a simple SME loan. So, what can banks learn from them? What they need to do is actually embrace customer experience as their central tenet. Customer experience, personalized products, digital distribution channels, and digital first products. These should be the central mantras for banks. And the way they go about doing it is by using cloud native applications, API connects, use AI ML algorithms, focus heavily on data, and make sure you're a customer centric organization. Now, in all this, we saw like what is changing in this world. What should the banks do to make sure they don't get disrupted by these new entrants? Now, let's take a look at where Indian GCOEs can play a role. For that, I'll ask Faraz to take over. Faraz will talk about the role of Indian GCOEs, and will also present on how the Indian GCOEs can contribute to their headquarters. Over to you, Faraz.
Thanks, Pawan. And hi, everyone, once again. Before I really get into the role of BFSI GCOEs in the digital revolution of the banking sector, right? I'll spend a few minutes just talking about the BFSI GCOE landscape itself. We've witnessed a steady flow of banking GCOEs coming into India from the pre-2000s. The likes of Citibank, ANZ, they've been here from quite some time. To most recently, MUFG, Blackstone, and new age banks such as Silicon Valley Bank have entered India. Today, we have about 85 banking GCOEs in India, with about 30 of them just being added in the last decade. Uh, However, what's really changed is the type of work that's coming into BFSI GCOEs in India. The change in definition of core and context in recent times as well. India was always known for a hub of operations type of work and gradually for IT services work, right? But today, increasing number of banks are driving digital engineering work from their respective GCOEs. Work profiles that leverage technologies such as RPA, AI/ML, data science, product development is considered today to be core of a BFSI GCOE. In fact, when we analyzed about 60% of the BFSI MNCs in India have E&D teams. Just in terms of talent, there are about 350,000 people working in BFSI GCOEs, with about 10% of these already in technology domains. If you look at it, these are quite large numbers, right? And if I were to put a COVID situation perspective to it, most of these 350,000 workforce really moved completely to work from home within just a week or couple of weeks of the nationwide lockdown, and in many cases even before the lockdown itself. Uh, this movement was, far quicker than the IT services ecosystem that they could achieve in terms of just business continuity readiness. And this gave the GCOEs a 2 weeks head start, right, in terms of just employee IT requirements, regulatory approvals, infrastructure readiness, and so on. Also, in terms of the spread of this particular talent, uh, erstwhile in a normal situation, 6 major hubs across India, but when we analyze, there are about 100 locations out of which these employees are working from rather. Uh, Further, what we did was, what we heard from the industry was there were concerns about productivity of employees, right, and effectiveness and efficiency. So what we did was we analyzed the roles of the roles in the BFSI GCOEs and mapped them on productivity vis-a-vis suitability of remote working, right? And we took multiple parameters to understand this. When we did this and plot this for IT roles, we found that almost all of the IT roles were able to smoothly transition to remote working as well as without any productivity losses. However, when we ran this analysis for operations roles, right, which are core to a bank even today, to our present surprise, we found that about 90% of these roles were not impacted due to this transition to remote working. The roles that did really well, and like you can see on the graph that we have here, delivery management and order tracking, order and invoice management, payments and collections from the commercial and wholesale banking space did quite well. Pitch book preparation, regulatory filings, and deal structuring from an investment banking side of things went well. Loan servicing, cash flow forecasting, underwriting, etc., were the ones that really saw higher productivity from a retail banking space. Uh, if you Right. And coupled with this, what did this pretty much do in terms of supporting the global counterparts, right? This large scale movement to remote working as well as higher productivity really supported the headquarters of the global organization in their bottom lines, right? And to Pawan's point earlier, there are various revenue hits that banking organizations are taking in terms of mortgage refinancing, missed payments, loan defaults, and those are some of the ones that we anticipate to continue. So, in both from a tech point of view as well as an operations point of view, we believe that the GCO ecosystem has played and continues to play a pivotal role, right, in terms of supporting the global organization as well as helping them in their bottom lines. Uh, However, we really believe that this is a true showcase of resilience of the BFSI GCO ecosystem. Our point of view is we as an ecosystem really need to move beyond just being resilient to becoming anti-fragile as an ecosystem, to learn from the situation that we have in hand and really become wiser and stronger. We believe the global pandemic situation today has given us GCOs a unique opportunity to revamp, recalibrate, and accelerate our growth, thereby exponentially contributing to the massive change that we just spoke about in the banking ecosystem that is already undergoing. In our opinion, there is a three-pronged strategy that organizations need to really leverage to really enable this. The first of which is portfolio relocation, right? And especially looking at it from an angle of digital engineering. What we did was we mapped the digital engineering work being driven in the banking industry across the entire value chain, and then plotted the portfolios that are being driven from India. What we found that currently there are only about 40% portfolios around digital engineering that are being run from India. However, our point of view is that about 70% of the global work, digital engineering work, can be driven from India. And given how uniquely we are placed, to drive this on several counts. One, if you look at the ecosystem that there is in India, specifically with respect to technology talent availability, there are the likes of Microsoft's, Google's, Amazon's that you can look at hiring experienced talent from and really take leadership in driving technology transformation, right? Increasing conversations that we have with banks, they're becoming more like product organizations, right? Being structured like that and they function like that. And as a result, we believe that BFSI GCOs can really take that lead. Besides, most of the large cloud platform companies have a presence in India. And given this, there's a huge opportunity to partner with them and drive your cloud migration portfolios from India. It is imperative, however, we build a strong business case for India on what is really possible. And we believe this, we're in a unique, we have a unique window of opportunity for the next few months, and we really need to capitalize on it, right? But while doing so, we believe that there might be scope for reallocation of portfolios, where some amount of operations work might go back to local locations due to challenges around data security, compliance, etc. Specifically, if the remote working situation continues for a longer time. And then we trade that with higher amounts of technology work coming in. The second key lever that we believe GCOs should really focus on, and we believe is also a low-hanging fruit, is a huge opportunity for BFSI GCOs to become global leaders in the space of automation, specifically automating the back and middle office work, and not just using RPA, but really looking at intelligent automation and now even hyper intelligent automation. There are several stages in the automation maturity journey, as you know. But when we analyzed organizations and GCOEs specifically on this four-stage map, we found about 75% of our BFS GCOEs really having automation charters that are basically rule-based, task-oriented, or taking action based on analysis of historic data. However, the future really lies in driving analysis based on real-time human behavior and sentiments, as well as tools that really have the ability to make decisions independently. We have a known example, and this is very popular in the ecosystem, which is about ANZ, right? ANZ incubated their GCO in India. They actually started work on automation with a small, with a then small startup, dare I say, Automation Anywhere. However, today ANZ has over 12,000 bots across the entire BFSI value chain and is almost a poster boy in terms of driving intelligent automation from India. Yeah, and on the other side, right? This helped Automation Anywhere to actually become a $7 billion startup now, right? This really shows the symbiosis capability between the MNC and startup ecosystem in India. And finally, coming to the third lever, we believe it's the most important one, right? In our opinion, we really believe that GCOEs need to stop driving incremental innovation, rather not stop driving, but continue to drive incremental innovation, but really start thinking about breakthrough innovation from India. If you look at the innovation charters of BFSI GCOEs today, most of them find itself at either an ideation stage or a problem solution stage or an MLP validation stage, right? Very few really reach prototype stage or even become part of the BU roadmap and drive revenue. Most of today's innovation programs run as HR activities, unfortunately. However, what is really required is to have a structured program that really is run by the business units, and these ideas really need to have logical conclusions and really be taken and integrated as part of the offerings in the long run. In addition to this, something that Pawan alluded to as well in terms of the global FinTech ecosystem that's really thriving, we don't think that it's any different in India. And it's extremely important that India GCOEs partner with this fintech ecosystem. There are about 800 plus active fintech startups, 250, around 250 funded fintech startups. And besides these, there are several hundred other deep tech startups that we can work with. And it now depends on individual organizations to really enable these partnerships with fintechs to be able to collaborate in one of the many approaches, right? Vendor agreements, acquihire, investments, acquisitions, etc. Um, in conclusion, we believe a combination of portfolio relocation, breakthrough innovation, and driving effective operations through intelligent automation is a powerful strategy. If used in unison, has the potential to really change the face of banking GCO industry in the times to come. We strongly believe that the BFSI GCO ecosystem today is at a pivotal junction where we can turn around the current challenge into an opportunity and leapfrog from being just a resilient GCO ecosystem into the realm of an anti-fragile ecosystem. Thank you.